there's a lot of things that are in place now that will make future recessions and financial crises radically different from the things that happened 50 years ago or 70 years ago or 100 years ago. And I don't think that a lot of people understand that.
Some of the base metals, including copper, have recently hit all-time highs. What's going on with the base metals commodities complex? What's going on with inflation? Some grocery stores are cutting prices. Big box stores are now cutting prices. We're not talking about disinflation. We're talking about outright deflation. So what's the outlook for inflation, and what's the outlook for gold and silver? Jeff Christian returns to the show. He is a managing partner of the CPM Group. Jeff, welcome back.
Well, thanks for having me back.
Yearly annual silver yearbook came out, and of course your gold yearbook came out 2 months ago. So we'll talk about silver and gold and highlights from your recent annual reports. First, let's talk about some recent news. So like I said in the introduction, Amazon is now reporting to be cutting their grocery prices by as much as 30%. The company said it will reduce prices of 4,000 items at its Amazon Fresh grocery stores online, as well as its handful of brick and mortar locations across the country. This follows as Target was making similar cuts last week and announced it was cutting prices on at least 5,000 of the store's most frequently bought items. Are we getting deflation now? What is going on?
No, we're not getting deflation. This is pretty much a normal reaction to a period of higher inflation. You know, it's very easy for retailers to raise their prices sharply during inflationary periods. They can run under the cover of the broader inflation. They tend to be very slow to lower their prices when wholesale prices come back down. So you've seen the wholesale prices for a number of goods, especially in various sectors of the food economy. You've seen the wholesale prices come off, but the retail prices have held up. And especially with Amazon, which is, you know, I don't shop at Amazon if I can help it. But I understand that their prices are pretty much premium prices compared to what I pay in my local grocery stores. So, you know, they had jacked their price up and they kept it high. And now they're at a point where you're seeing consumer resistance to higher prices. You're seeing consumers shift away from high price premiums services more toward normal grocery stores, and you're starting to see price resistance. You know, in addition to that, you are seeing a slower economy. So I think that you have some of these big box retailers sort of looking at waning sales, saying we have to be more competitive. It's not a deflationary thing. It's a disinflationary thing in one sector of the economy.
Food has relatively inelastic demand, meaning that, you know, people typically don't change food consumption patterns unless the price moves dramatically. What I'm trying to say is, Jeff, is it a leading indicator for weak consumer strength if big box stores are lowering prices on their, I guess, their least elastic items?
Well, first off, people do change their food habits. And one of the things we've seen over the last 4 years is a dramatic shift away from beef. Beef prices at a retail level have been very high, while wholesale beef prices have been driven to historic low levels. So the big meat packing companies and the big wholesalers have really been squeezing the ranchers and squeezing the consumers. So you've seen a sharp decline in the consumption of beef in the United States. You've seen other things too. So people have moved away from packaged foods more to fresh vegetables and other things. They've moved away from name brand canned goods and frozen goods to generic store, you know, Crasdale and other generic in-store brands. So you have seen things. Obviously, you know, people want to eat. People do need to eat, but you have seen that. You've also seen a number of lower income families severely constrained price-wise and cutting back on their food simply because they don't have the money to pay for it. So there is some price elasticity of food, and you're seeing that effect right now.
I think you're absolutely right. I was at Costco over the weekend. Personal anecdote. I wanted to buy steak, but I didn't feel like paying $90 for four. so I ended up buying chicken instead. So yeah, I think there's some truth in that. Your general outlook on inflation is the theme of our conversation today before we talk about base metals. This I was reading about, it's quite interesting. The Treasury General Account, TGA, swelled up to nearly $930 billion by April 24th. This is well in excess of the department's target of $750 billion. The extra cash is providing what a Deutsche Bank strategist called a TGA gravy train, which some strategists are suggesting it may be the cause for stickier inflation, despite what the Fed may be trying to do. So can we comment on that, whether or not what the Treasury is doing is conflicting with what the Fed is trying to do?
Well, I've been saying all along that the thing that people should be focusing on are fiscal policies, and the fiscal policies remain very stimulative. They were outrageously stimulative in the period 2020 to 2020 into 2022. They have been being cut back not only in the United States, but really in a number of other countries, and that's going to continue. But even with the cutbacks, fiscal spending and excess fiscal spending in excess of fiscal incomes on the part of governments continues to be historically very high. And that's going to continue. So I looked at the $900 billion for the first 7 months, and that did not seem out of line with some of the estimates of like a 1.7 billion spending deficit for the full fiscal year through September. It is much higher than what was budgeted, but that's what the government's been doing for 40 years now, 43 years now. And as Dick Cheney famously said, as far as politicians are concerned, deficits don't matter. And they act that way. So it's the fiscal policy. Now, the fiscal policy is at odds with the monetary policy. Monetary authorities are trying to restrain inflationary pressures while also keeping the economy out of a recession. But the excessive fiscal stimuli from the federal government as well as state and local governments puts a kink in the monetary policy's ability to bring the economy down without throwing it into a recession.
Do you think that fiscal policies would change dramatically following November's election? Either we get a Biden or a Trump re-election, both would have a second-term presidency.
I think that you would probably have an even larger budget deficit over the next 4 years under Trump than you would under Biden. I mean, that's what past projections have been. And if you look at the two of them and their past spending habits, Biden is not a fiscal strict constructionist. He's not going to do what needs to be done on a fiscal policy side to restore fiscal order to the federal government. But I think that Trump would be even more stimulative than would Biden. But I think that regardless of who wins, we have a very big fiscal problem.
Is it really a problem? Let me just provide a counter example to this.
Yeah.
The G7 countries have all seen a technical recession over the last year and a half, all except the US. Some would argue this is because of this fiscal stimulus that you call a problem.
Well, I think that you have to look from country to country. Some of the countries actually probably tipped into numerical recessions because they have tried to restrain some of the fiscal stimuli that they put in place in 2020 and 2021. And you have to do that very carefully. Other countries like Germany have been facing really economy, supply and demand issues. Germany is close to Russia. It was a large trading partner with Russia. It has suffered mightily from that. It's paying more for its fuel imports now. It and other European countries are increasing their defense spending. So I think that it varies from country to country. But what we have been seeing and what we've been pointing out at CPM Group for more than a year was that you're seeing a slowing to some extent of overall economic activity, not just in the US, but in most developed countries and in some developing countries, including China and to a lesser extent, India, but also in South Africa and Brazil, and obviously in Russia. So you are seeing slower economic activity as a result of a variety of factors, including governments in some countries trying to reduce their fiscal deficits.
Tying all this together, your general outlook on inflation, then, given that you think that perhaps the deficit may widen post 2024, I'm assuming you don't think inflation will come down below 2% anytime soon?
I'm tempted to use the old joke, not in my lifetime, but
Really? Okay.
hopefully I'll live longer than that. I don't see 2% inflation in the United States in terms of CPI for the next 2 or 3 years at least. So I think that you're going to see inflation moving slowly down from, presently it's, depending on which you look at it, headline or core, it's 3.2, 3.8%. I think you'll see it moving slowly down from those 3+ levels to 2+ levels over the next 3 years, unless something really dramatically bad happens in the United States, which is highly probable.
Let's segue into the metals now. So copper has had a tremendous run. Do you think the base metals overall are due for a pullback, especially after copper's run to new all-time highs?
Well, yeah, I mean, all of the base metals have done somewhat better, and that has reflected a more optimistic view toward economic activity than was present a year ago. A year ago, people were still saying, oh, we're moving into a recession and it could be tough. And what you've seen is that while you are seeing economic activity slow dramatically, you're seeing relatively strong demand for manufactured goods. And as a result, there are any number of manufacturers who used base metals in their products who had reduced their inventories over the last couple of years of raw materials, and now they're rebuilding their inventories. So that's sort of across the base metals. With copper, you've had some special interruptions in supply, and you've had some other factors in the market, which has caused silver to be much more volatile to the upside. So, it went from about $4 not too long ago to more than $5. Now it's down to about $4.80 a pound. And so you're seeing that volatility greatest in copper, probably because the inventories had been worn down the most. But you're seeing supply and demand factors driving most of those metals.
Is there a shortage of copper right now?
I don't think there's a shortage of copper. I'd have to ask Carlos Sanchez, my partner who follows the base metals. I don't think there's a shortage of copper per se. There was a shortage, obviously, in the COMEX, and you had some congestion going into a recent futures delivery month. But that was probably good for 50 cents to the upside, which took the price over $5. That's behind the market now, and you've seen the price come off. But I think that if you look at it on a global basis, we still have a surplus. The surplus is much smaller than it has been over the last 2 or 3 years or 4 years, going back to 2020, when the surplus was very large because of the shutdown. You still have a surplus from what I can tell, but it's much smaller and the market is much tighter. And then you have some, as I said, geographic disruptions, for example, with COMEX deliveries.
Jeff Curry, formerly at Goldman Sachs, now at Carlyle, he told Bloomberg copper is the best long trade he's ever seen. This is a recent interview. Do you share his sentiments?
Probably not.
Okay.
I tend to be a value investor.
All right. So it's not that copper doesn't have good fundamentals long term. It's just that the price right now is overstretched for you to be a buyer.
Copper has good fundamentals in the intermediate term, the next 3 to 5 years, and it has probably good longer term fundamentals the next 10 years. Although the longer term fundamentals are probably not as bullish as a lot of investors think, because a lot of investors have gotten very bullish on copper based on this whole energy transition going to use a lot of copper? It is going to use a lot of copper, but there's a lot of copper out there to be used. And the market is not nearly as tight as some people seem to believe it is. So, we're bullish to some extent in the long term on copper, but we're not as bullish as most other people. But then you have to look at the short term, the next 2 months, the next 3 months. And there, I don't think that you necessarily can justify $4.80 or $5 a pound.
There's a lot of sexy narratives out there surrounding AI. One of them is that with the advent of AI, a lot more data centers will need to be built. These data centers will need copper and other base metals. How much of technology or the tech sector, sorry, how much of copper's demand comes from the tech sector versus construction, let's say, which is traditionally
well, I can answer it in a comparative sense.
Yeah.
Much more copper goes into construction and transportation than goes into electronics.
Okay.
Electronics is important, and it's a area of strong increases in demand, but much more copper goes into construction and transportation.
Okay. So let's talk about silver and gold now. So starting with silver, your recent yearbook came out. Like I said, people can go to the CPM Group to get a copy of that yearbook, right? And also, I saw you have a video on your YouTube channel. It's an hour-long presentation. I'll put the link down below so people can check that out if they want more detail. But today we're just going to go over the highlights. So, well, give us your start. Let's start with your outlook for silver and where you think the price is going to head from here, and then we'll get into the fundamentals.
Yeah, I should say the video is actually 90 minutes. So,
Oh, you're not even, an hour-long presentation, and then you have 30 minutes of Q&A. Right.
Yeah. So get a big gulp before you sit down to watch it. Our overall view on silver is that we are in a much tighter market. We have seen investment demand come down over the last couple of years. It started to pick up in the middle of March a little bit, but I think that was probably a short-term blip. We've seen investors are still buying silver, but other investors are selling silver. It's a situation very similar to what we saw in the late 1980s. You had seen the price rise up to $50 on an intraday basis in 1980. And then it came down rapidly to $16, and then it was $8, and then it was $7, and then $6, and then $5, and then $3.50. And over that period of time, investors were selling. Other investors continued to buy. They were, let's go, it's going back to 50. So if these guys want to sell it to me for $6, I'll buy it at $6. If these guys want to sell it to me at $3.50, I'll buy it at $3.50. But by 1990, the bulls had sort of given up the ghost. It had been 10 years, and the copper price or the silver price hadn't recovered. And you're seeing a very similar dynamic right now. You're seeing stronger fabrication demand, silver use in electronics, in automotive electronics, in solar panels, all rose, in the case of solar panels, strongly last year. Part of that probably has gone into inventory building. So we still see solar panels using more silver this year, but the growth rate probably will be much smaller than it was in 2023. But you've seen stronger fabrication demand offsetting that lower investment demand. And that sort of kept the price of silver between, say, $22 and $25 for much of the last year and a half, 2 years. It broke above that in the middle of March, and it made a run up to $32.75 or so a couple of weeks ago. It's back down. The last I looked, it was around $30. Our expectation on a short-term basis is, 26, 27 on the low end to 32 on the high end. We still have the view that if we get into the kind of severe economic, financial, and political problems that we have been talking about in late 2024, early 2025, that the price of silver could spike sharply higher. If you go back to 2021, our expectation was that the nominal price of silver could average $40 next year. Now, I think our average projection for 2025 is probably closer to $35. So we've lowered our price expectations somewhat for the next 2 years, but they're still very high. I mean, $35 annual average price would be roughly equivalent to the record annual average price you saw in 2011, 2012. So we're looking for higher prices later this year into next year. And that's predicated on a combination of factors: strong fabrication demand continuing, even if we go into a recession, supply constraints, and then the return of investors, which is what happened in 2005.
Return of what kind of investors?
Physical investors for coins and bars. You saw investors being net sellers from 1990 through 2004, 2005. And in the period 2001 to 2005, they were progressively selling less on a net basis because more investors were saying, okay, wait, the price has been trading between $3.50 and $5.50 for 15 years now. If I stop selling today, I might get a higher price tomorrow. And that was the mechanism that caused the silver price to start rising. As the silver price started rising, 2004, 2005, 2006, other investors said, I think I'll wait and see how high the price goes before I sell. And the price went from $5 in 2005 to, $35 on average in 2011.
Part of the reason for why gold went up is due to Chinese demand of the physical metal earlier this year and late last year. Could the same reason be applied to why silver went up this year? Chinese buyers?
It's definitely a factor. I wouldn't blame the Chinese investors or fabricators or central bank in the case of the gold market for everything, because we've seen strong demand across fabrication industries around the world. So we've seen strong demand in gold and silver in China, in gold and silver for fabrication in India, and for fabrication demand in other parts of the world, including the United States, Japan, Europe, and other countries. So, I think that that's really the driver at this point.
There's a chart here in your presentation showing above ground silver bullion inventories, and coinage you have here in the green portion of the chart. It's been expanding, and so I'm guessing that if physical buyers are thinking about potential shortage, that's not going to be an issue.
Well, I don't think they're thinking. It depends on how you define shortage. I would say that reasonable people who don't know anything about silver don't expect a shortage or there's just no silver to be had. What they do expect is the potential for deficits of newly refined metal over fabrication demand and much tighter supplies, the way you see it now. The fact is, as that chart shows, you've got 5.5 billion ounces of silver in refined bullion and coins, and about 1.6 billion, I think, is in coins. That can be readily resold. And we have seen over the last 4 or 5 months, significant resales of silver coins and silver bars. One of the reasons why silver coin premia have fallen so far this year is that investors are selling their coins back to the dealers. The dealers don't need to buy new coins from the mints and the wholesalers. They can resell the ones that they're buying from investors who had bought earlier. So that reduces the demand for new silver coins, and it reduces the premium. That's a sign of weakness in the investment demand market. And it's a sign that, despite what some promoters say, some investors will sell some of their metal. Just as we saw in the late 1970s, early 1980s, you saw investors selling silver into the price rise, and you're seeing it again now. And if the price rises further, it'll be more intense.
Do we have any evidence on whether or not the ETFs will be more popular for retail investors than the physical bullion itself?
What we've seen, and especially in gold, is a shift away from gold ETFs to gold bullion. You've seen a little bit of that in silver, but it's been more prominent in gold. And that probably reflects the fact that investment demand for gold has been more prominent over the last 4 years than has silver demand. And what that represents is concerns about counterparty risk. If you own gold bullion and you store it in a depository, either allocated or unallocated, you own gold. If you own a gold ETF share, you own a share of a Channel Island company that owns gold that's not readily, available to you. And that Channel Island company is managed and administered by financial intermediaries. And there is a concern about the stability of the financial marketplace and financial counterparts. And so what we've seen over the last 3.5 years, from really early 2021 into the first quarter of this year, was you saw investors selling their gold ETFs, but buying physical gold. They were buying increased volumes of physical gold while they were selling gold ETFs. And it wasn't that they were down on gold, the ETF sellers. It was that they were worried about counterparty risk. And I think that that's probably going to be a very strong headwind for gold and silver ETFs going forward.
Do ETF inflows and outflows affect the underlying price of the metal?
To some extent, yes. ETFs now represent about 10% of above ground investor holdings of gold. So they have a real factor there. In addition to that, ETFs are very easy to sell or buy instantaneously. So in late March, for example, you saw an uptick in gold ETF buying. And that was any number of people who did not have exposure to gold. They saw the gold price rising in March and April to record levels. They wanted to buy gold exposure. If they wanted to buy physical gold exposure, if it was coins, they'd be paying a premium. If it were bars, it would be 2-day settlement. But with ETFs, it was a couple of keystrokes and pow, I have my gold exposure. So what we saw in late March, and I'm not sure what the story was in April, was that investors turned to gold ETFs because they're the easiest and fastest way to buy and sell gold price exposure. And I think that that will continue to be a factor, especially if we see the kind of price volatility the CPM Group is projecting.
Gold and silver. This is a very basic question, but maybe explain to our audience, is there a fundamental reason as to why these two metals move usually in tandem with each other?
Broadly in tandem, they do move together. It's primarily because they're somewhat interchangeable as fungible quasi-currencies. They both have history of being used in currency systems up until the last century at various times. And they both are quasi-money, and they're both very important financial assets for portfolio diversification. So to some extent, they both are bought and sold by investors for the same reasons at the same times, and they move together. Now, there's divergence because they don't move tick for tick together. So there are times when people say, I prefer gold for a variety of reasons, and there are more investors who buy gold worldwide than buy silver worldwide, or more investor dollars that go into gold than go into silver. So there is some differential. And when you see the price differential get too far out of line, you'll see people say, I'm not going to buy gold, I'm going to buy silver because its price is so cheap relative to gold. There's no magic ratio, but the ratios ranged from 16-1 to 120-1 over the last 50 years of free gold prices and free silver prices. So there's no magic ratio, but you'll see investors trade off one to the other due to the relative price. That helps keep the prices moving together roughly in the same direction, roughly in similar intensities.
Do central banks buy silver as part of their reserves?
No, they don't. Silver is not a monetary reserve in the eyes of the central banking industry, the Bank for International Settlement.
But if they're both quasi money, I mean, shouldn't it be?
No, I mean, you're talking about money, And for the monetary reserves of central banks, the central banks of the world have gotten together and they said, what qualifies as a monetary reserve? And the purpose of monetary reserves is to have a safe, a kitty to protect your currency against volatility and selling, and also as a safety net. And in order for an asset to be a safety net, it has to have a certain liquidity. Currencies have that sufficient liquidity, and gold has this similar liquidity. So the international central banking community has said these are tier one assets suitable for use in monetary reserves. Silver doesn't meet those qualifications. It's too small and illiquid of a market. So no, you can't have silver or platinum or other commodities as part of your monetary reserves. You can have them, but not as monetary reserves.
If you just take a look at gold's and silver's performances together, just based on the fact that gold has reached new all-time highs this year and silver has not, what does that tell you about the world, Jeff?
It tells me that more investors in more parts of the world prefer gold to silver as a financial asset, as a portfolio diversifier, as a hedge against inflation, as a hedge against currency market volatility, as a hedge against political uncertainty, as a hedge against war and civil war and everything else, that, as has been the case for most of the last 6 or 7 millennia, gold is preferred over silver for all of those financial purposes.
So when the gold silver ratio goes up higher, can we make the conclusion that it's a leading indicator for more instability in financial markets?
It's an indicator that the consensus in the financial markets is that we're going to see increased financial, economic, and political instability.
So on to gold now. Is there a legitimate concern, or are you concerned that gold's rally is over?
I don't think so. I mean, I think that gold has another 6 to 24 months of upward movement in prices. And I'll tell you, it's not that I look at where the price of gold is. I do look at that, and I do look at the price of gold relative to fabrication demand and relative to mine production costs and secondary recovery. But what the real kicker is, look at investment demand, which is the driver for gold prices, and then look at the factors that drive investment demand. And I just mentioned inflation, currency market instability, political instability, both domestic and international, financial market instability, the potential for a stock market decline, economic activity, a portfolio diversifier, a safe haven for your wealth and preservation of your wealth. All of those factors, we look at those and we see a world where all of those things are yelling at investors, you should be buying more gold. And until I see a more sanguine economic and political environment, I think that the gold price will continue to rise.
In 2011, when gold price hit its then all-time high, it then came down and stayed flat for a number of years, as you know. How would you convince someone who's worried about a repeat of that scenario that this time may be different?
I wouldn't. Yeah, I think that the increase into 2011 and the subsequent decline, we predicted, when the price got to 20 in September 2011, between September and January, we said, sell your gold, sell your silver. We actually said, sell your silver at the end of April 2011. But in that last 4 months of 2011, we said, sell your gold. The move is over. We expect the gold price to decline for the next 3 to 5 years. We thought it could get down to 2014. It got down to 2100.
What was the reasoning back then for 3 to 5 years?
Our expectations of the economic and political environment from 2012 going forward. We thought that things would be less severe, and we thought that investors would be focusing on other segments of the financial system. So we were right. The price stayed low until 2019, and then it started rising. By 2019, you had a worsening economic and political scenario and environment. So we look at it that way. So I would not, I would say to an investor, don't look at it this time being different from the last time. I would look at this time being like the last time. For you to say this time is different from the last time, you have to be one of those guys that you always interview who say, oh, everything's going to collapse. And things don't collapse. We have a recession, we have a financial crisis, a couple banks go out of business, but then we get better. That's what happened from 2012 through 2019. So for me to say that things are different this time, I would have to join that club of people who have been perennially wrong for their entire career. And I'm not about to do that. What I am about to do is say gold has these functions, and as long as the political and economic environment is as unsettled as it is now or gets worse, you should expect gold to do well. When things get better, we're probably going to say sell.
What I'm trying to understand is post 2011, the real interest rate in the U.S. kept going down. As you know, inflation was kind of steady. Nominal rates fell, but gold didn't go up as a result of real rates going down. I mean, why?
Well, the correlation between changes in the real interest rate and the changes in real gold price is zero. So you don't really expect that. If you look at it, there's about a negative 16% correlation. So about 16% of the time, gold rises when interest rates are falling or falls when interest rates are rising. The rest of the time, they are not correlated as assets. So when we saw the interest rates fall, we looked at why the interest rates were falling, what the monetary authority of the world were doing. And we said, we don't think that this is necessarily going to make things worse. We think that this could make things better economically. Ergo, you didn't need to have as much gold in your portfolio.
Well, that is somewhat surprising to me because I've talked to a lot of people, and this is one of the indicators people think is most consistently inversely correlated to gold. So this comes as kind of a revelation to me, to be frank. What is then the best indicator or contra indicator for gold prices? Is there any indicator, any variable that is more consistently correlated?
I've never found one. Yeah. I look
US dollar?
The dollar, the corollary is about 38%. So it's a little bit better, maybe 32%. It's a little bit better, but you'll find times like now in the last year or so where the dollar and treasuries, demand for U.S. treasuries, the U.S. dollar exchange rate and gold price are all actually up. So because when things get really bad, the two safest havens are the U.S. dollar and gold. So when things get really scary, investors move into gold, they move into the dollar, and they rise together. And that's actually what you've been seeing over the last year or two. I mean, I'm sure you interview these guys all the time. You're talking about the dollar collapsing. The dollar is up like 30% from where it was 5 years ago.
Sure. Yeah,
and
gold's up 80% since 5 years ago. I was just looking at it. So yeah, they've been moving in this. You're right. They've been moving in the same direction on the long-term basis.
What's the euro done? Yeah, I mean,
I understand. Yeah, I understand. But does it not stand to reason though that if interest rates go up, let's say that the yield on the 10-year goes up, I would be more comfortable just parking my cash in a T-bill and collecting my yield than putting it in something like gold, which doesn't give me yield and is also perceived as a safe haven.
Right.
Why put it in gold, which could be volatile, when I could put it in another risk-free asset that gives me a yield? I mean, so does that make sense to you that when interest rates go up, the opportunity cost of holding gold goes up as well?
Absolutely. That's absolutely true. And we have clients who think that way. And, in particular in the Chinese financial markets, there's this all-in mentality. When the stock market's rising, I'm all into the stock market. And we'll say to them, hey, the stock market's up very sharply. It's looking top heavy. Shouldn't you cycle some of that into gold? And they'll say, no, I won't start buying gold and selling stocks until the stock market is actually collapsing. So you do see that. But really wise investors say, okay, given where the economy is, and first off, the first thing we always say is when you see interest rate changes, you have to say, why are the interest rates changing? Because that's probably more important than the actual change in the interest rate in terms of the price of gold and the relationship between gold and interest rates. But really wise investors say, okay, given where we were in 2023, where we are today in the first half of 2024, I want to own gold and I want to own treasuries. That's why, again, in the face of what you've probably heard people tell you, there was a 10.5% increase in foreign demand for U.S. treasuries last year to a record $8 trillion. So foreigners are not dumping U.S. treasuries the same way they're not dumping gold. They are moving into gold and they're moving into treasuries. And there's enough wealth for both. You don't have to say, oh, things are getting nasty. I need a safe haven. Eeny, meeny, miny, mo. I'm going to pick gold or I'm going to pick treasuries. You can say, okay, things are getting nasty. I need a safe haven. I'll put 30% of this excess cash into gold and 70% into treasuries.
China did sell treasuries earlier this year, correct? Sold about $50 billion worth.
They were selling
and agency
treasuries
bonds
earlier that they had bought with a 25% interest rate. And then they started buying treasuries because they had 5.25% interest rates. Yeah. Like, oh, and you're gonna, and I'm sure you've had guys on your show who said the Chinese government's stupid. They were selling treasuries and then they bought them. They were selling things that were earning 25 bips and they're replacing them with things that are earning 5.25. I'll do that trade every day.
Let's close off on this. You talked to a lot of people in the gold and silver industry. I don't know, what are some of the biggest misconceptions about silver and or gold that you just want to clear up before?
God,
I know
you
it's
don't
just
have enough
one or
time.
just something that,
Yeah.
that you've been hearing a lot that maybe you like to clarify. Just one thing.
Yeah. Gold doesn't trade against the dollar.
Okay. Yeah, we just discussed that. But we talked about the math. We didn't talk about the reasoning. Gold is not seen as the anti-dollar asset. That's how it's marketed. No?
Some people market it that way.
Okay. So why are a lot of people in the gold industry calling for a dollar collapse, hoping that that'll push up gold? What's the logic here? Is there any logic to that?
That's a loose definition of the term logic. I think a lot of it has to do with a mental precondition to look for bad things to happen and expect bad things to happen. There's also part of it is a reliance on long-term history and a reluctance to understand that the financial system, the monetary system, fiscal policy, monetary policy, everything has changed dramatically since 1907 to 1913. In 1907, we had a bank crisis. We didn't have a central bank. We had state chartered banks. They were corrupt beyond belief. They were paying off congressmen to keep the government from creating a central national bank. And from 1907 to 1930, in 90 months, we were in recessions for 60 of them. A recent recession, 2007 to 2009 was like the worst recession since the Great Depression. And it lasted, 17 months or less? You had a terrible situation up until 1913, 1914. And yes, that's the creation of the Fed. But since that time, you have had progressively better monetary understanding of the system. And you've seen since 1982, longer economic growth periods, shorter and shallower recessions, with the exception of 2007 to 2009. Thank you very much, Mr. Cheney. You have seen much better understanding by monetary authorities how to deal with fiscal irresponsibility. And that has kept us going. Also, you hear these guys and they talk about the Great Depression. It's going to be worse. When we went into the Great Depression, we didn't have Social Security. We didn't have unemployment insurance. We didn't have housing support or any of these other things. We didn't have industrial policy support for the companies, let alone the people who work for those companies. And so the Great Depression was a time when the government said, wow, I guess maybe we do have some responsibility to be involved here. And they started requiring things like Social Security. And Social Security has worked very well. And the truth is that it's actually very well financed. And a very small tinkering with the rates could make it what they would call perpetually funded. So there's a lot of things that are in place now that will make future recessions and financial crises radically different from the things that happened 50 years ago or 70 years ago or 100 years ago. And I don't think that a lot of people understand that.
Well, we can understand more by reading the Silver Yearbook, hopefully. Where can we go to access that?
www.cpmgroup.com.
All right. We'll put the link down below, so make sure to check that out. Thank you very much for your time today. Jeff, always good to have you on.
Thanks for taking the time.
And thank you for watching. Don't forget to like and subscribe.